Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Hello, and thank you for attending Standard Chartered's Opportunities in Asia's Transforming Credit Landscapes event. We are privileged to have an extremely experienced panel today, representing both North and South Asia, and issuers and investors. Let me first introduce them. We have Kenneth Francisco, who's the Director of Asset Management at the Bureau of Treasury. Unfortunately, Rosalia was called away at the last minute, and Kenneth is graciously standing in for her. We have Julian Lee, Executive Director of Finance at the Airport Authority of Hong Kong. Umesh Srivanka, CEO of Shriram Transport. Wo Chao Fu, CIO for Fixed Income at CICC. David Yim, Head of DCM for Greater China and North Asia at Standard Chartered Bank. And myself, Duncan Robinson, from the Standard Chartered Credit Trading Team. So the Asian credit market has grown substantially over the last decade. As we exited the GFC, the overall notional of G3 credit was around $350 billion. China represented only 15 to 20% of that. Since then, of course, Chinese issuers have become the largest borrowers in the market. And other regional domestic borrowers have taken advantage of surplus funds sitting on shore, with the result that the market has now grown to $1.2 trillion. We are now looking at entering a new phase of the market, to enter a post-COVID world with increased importance and focus on ESG. But with echoes of our previous era, low rates, altered supply chains, and sanctions which will still run their course through the market. Though hopefully the era of checking our Twitter accounts every morning to see the market's direction is hopefully now behind us. So for some details of what this world might start to look like, let's turn to the panelists. Starting with you, Umesh. COVID-19 crisis is clearly affecting India terribly, and Shriram as a microfinancer is at the centre of that storm. What measures are being taken to steer through this, and do you think any of them in time will become permanent?
Thank you. Thank you for to be here with you here today. See, in the COVID-19, when it started last March, it was unknown for us, and nobody knew how to really react in the initial days. But the nationwide lockdown helped us to get back to drawing room and build a plan for managing. And what we did is we tried to build a digital platform to reach to the customers. Most of our customers are individuals. They are always on the road. And since we are financing road transport operators, so we try to reach to them through mobile and make digital transaction, and all precautions on safety, social distancing, on masks, sanitizers, everything was provided to the customers. And we also took some kind of guidance to them to behave and manage themselves better. So these camps we did in remote places like petrol pumps, and try to reach out to maximum number of people. And thereby we try to minimize the risk. The second thing what we did is we try to help the customers by giving credit on mobile. They can take the fuel credits or whatever they needed, or immediate credit requirement on mobile platform, so that they need not visit the office for every credit requirement. So that also helped the traffic of the customer walking into the office. And overall, the relationship building exercise with customers continued remotely and also through some physical camps. And we also have done some additional product lines to the customers, like the Reserve Bank of India announced a moratorium period to the customers. We offered the moratorium to all our customers across, whether they are earning or not earning. And we also informed them simultaneously that they can start repaying even when they are in moratorium. So those customers who could apply their vehicle and operate, they were very happy to keep servicing the loan even when they were in moratorium. So the momentum was kept throughout, and post-September, when the moratorium was lifted, when economy came back, most of the customers were on time in their repayment, and even the credit demand went up from October onwards. The October to December and Jan to March, the credit demand also went up significantly because of pent-up demand and economy coming back to the normalcy. However, during the COVID surge too, April and May, we had a separate set of challenges. This time, the challenge was the virus had spread into hinterland, and that created some uncertainty on the movement of the goods in the rural area, where we tried to give support to them by extending a further credit so that they can get out of the restricted zone to more other zones where they could do the business.
Okay, thanks so much. It certainly sounds as if you managed to use the COVID era to sort of accelerate your business there. You recently issued a social bond. The market has been increasingly focused on ESG, but most of that has been around the E component, and less so on the others. As a pioneer in this market sector, did you find that you were reaching new investors, and do you expect that part of the business to grow?
Yeah, basically, we were the first company to issue a social bond from India. We are pioneer in financing to the customers who are buying the commercial vehicles. We are actually financing entire transportation segment per se. One area we have specialized ourselves is first-time buyers. Many of these customers are buying the vehicle for the first time to start their business. Being a first-time entrepreneur, they don't have a financial track record to go to a bank or established financial institution. But we identify such customers and give them a sustainable income through an acquisition of asset. The asset could be vehicle, it could be agricultural equipment, it could be passenger vehicle, but it gives them a sustainable income over the next 3 to 4 years as when they acquire the vehicle. And as they repay the loan, the asset becomes free, and they have option to buy another vehicle or upgrade themselves to buy the newer vehicle. What we do is we fund them when they buy a used vehicle to start their business, because when they start the business, the capital is less, so they could buy only used vehicle, and subsequently they upgrade themselves. So we have progressed the customer from using the Euro 1 vehicle, Euro 1 standard vehicle, to now Euro 6. Most of the customers are upgrading over the period, and we restrict ourselves to fund up to 10 years old. So many of these customers upgrade themselves to buy younger and newer vehicle, and helping the cost, environmental cost, and also socially, we are trying to empower many different segments. One is a weak income group, a woman entrepreneur who would like to come into the business, sometimes as partner or sometimes as standalone. And we also are lending into laggard states. There are some states in India which are economically weak, and those areas we are trying to lend to more number of customers. Idea is to basically give a sustainable income and uplift people to become entrepreneur. So that is the idea. And the social bond was something which really helped us to showcase the effort done by us and also customer in coming up in their lives. And we have seen people that, especially those people who are driver, once they become owner, their behavioral change is something to be recognized. And in Indian society, the entrepreneurs are appreciated than the people who are worker. And therefore, in the social circle, they are looked at as the owner of an entrepreneur, and thereby the family gets better recognition. So we are continuously trying to promote this, and at the bottom of the pyramid, underbanked and unbanked customers, we have been encouraging. And through the social bond is one real good instrument for us to bring them to the international platform.
That's great, Kenneth. Umesh, and we look forward to working on the next deal with you. Moving across to Kenneth. There's been a significant increase in supply from the Philippines in 2020, both at the sovereign and the corporate and banking levels. In 2020, that was $15 billion versus $5 billion in 2019. Do you expect that increased supply to continue?
Well, thank you for the question. The increase is likely temporary. It's a product of the pandemic, of course. And seeing that there's no imminent resolution to the pandemic, we expect it to stay at least for the near term, but not over the long term. For example, in the case of the Philippines, the demand, the massive shock to the revenues and the demand for COVID spending increased our issuance from 1 trillion pesos to 3 trillion pesos, or for our dollar issuance from the usual 3 billion per year to 6.6 billion last year and 7 billion this year. And that is to provide for the requirements of the COVID-19 response. But we have to remember, add to the fact that the pandemic is very permissive for borrowing. We all know that the central banks had to reduce, all over the world have to reduce their borrowing key interest rates to accommodate their economies. Now, over the longer term, we don't expect this to be sustained, given that we are still bound by our commitment towards that sustainability. Credit rating agencies are already flagging the erosion of our buffers in terms of debt to GDP, where the Philippines increased by around 15 percentage points. And as soon as there is recovery in our revenue collections, then we will consolidate our fiscal deficit and along with it, our issuance in both the domestic and external market.
Okay, thanks, Ken. And talking of on sustaining on that track on the issuance, we've seen a lot of supply of very long dated paper from many sovereigns around the world, sort of the 40-year and plus, or even even the occasional century bond. At the moment, the Philippines is restricted to 25 years. Do you perceive that to be changed in the future?
That is correct. We have a statutory limit on our bond issuances for both domestic and external debt for 25 years. Seeing that right now the legislative focus is on the resolution of COVID-19, and of course we are having our elections next year, we don't anticipate any change to that right now. But if you can glance on our issuance recently, we have been pushing, especially with the Euro deal this year, we have been pushing towards the longer end of the curve, knowing that that is our lean against the wind. of course, we're having an increase in our debt, but it certainly helps that if we are going to issue on the long end of the curve, then the repayment will be far away down the road.
Okay, that's great. Thanks a lot, Kenneth, and thank you again for standing in at the last moment. Moving across to Julian. COVID obviously has affected the aviation sector very badly. Business and tourism travel may not even return this year, certainly not to its pre-COVID levels. How has that affected the airport authority's financials and business outlook, and has it altered your capex plan?
Well, I think we all know that the COVID has a significant impact to the whole aviation industry. I think before COVID, our airport, usually every year we have around like 75 million passengers throughput, and also a cargo throughput of, plus or minus around like 4.7 million tons of cargo, which is, one of the leading airports in the world. And I think every year we run around like in US dollars term, having around like 2 billion adjusted EBITDA of our operating cash flow. So I think when COVID hits in the early of the year, we were very cautious and very uncertain in terms of the outlook and the way the aviation is going to work. I think bear in mind, I think you mentioned about this capex. The airport authority is in the midst of a very significant capex expansion program where we undertake to build a third runway system to expand our passenger throughput from a 70 million passenger per million. We're right in the middle of it. And so, given this is a very significant undertaking and really in the middle of it, we undertake it to complete it on time and on target. And so, as you can imagine, we are in a situation where you have a very uncertain drop in terms of operating free cash flow around, used to be around like 2 billion US, where and the funding of the continuously for the capex to get the third runway done in an on-time manner. So I think that we quickly sort of like try to assess and basically look around and have to sort of like predict what sort of like traffic outflow and traffic flow is going to be. Hong Kong being an international airport is quite significantly impacted. We don't have a domestic market, and all our passenger traffics are international, so it shut down effectively. Represent a more than 95% drops in terms of our passenger traffic, and so we immediately try to look into sort of like the impact of our finances. I think fortunately we started off with a very conservative base where in the earlier years even before COVID we were in a net cash position, and so we I guess we had the foresight and have put sufficient buffer to basically accommodate such stress tests. And so, but obviously, given this uncertainty, we look closely in the market because obviously with the shortage of the operating free cash flow, the obvious way is to raise capital through external financial sources. Last year was a very interesting year. When you look into the second half, interest rate was hitting in a very low environment. And in Hong Kong, there are multiple blue chips company were issuing perpetual securities at that time. And so we that sort of like really triggered us to think about like our balance sheets and, are there any ways for us to better manage our balance sheet given that environment? And so I think around late December, we decided to launch a 1.5 billion, two tranches perpetual securities issuance at a very, we're fortunate, and a very low interest rate. And so we believe that would actually provide us a good buffer in terms of balance sheet, in terms of accounting equity. And also given the uncertainty in terms of the outlook of aviation, under the right market condition, we believe that that will provide a good cushion for us to address the uncertainty in terms of traffic and our operating free cash flow. And subsequent to that, we managed to issue, I think in January, two tranches, 1.5 billion, 10-year and also 30-year, which was mentioned by Duncan. A long-term 144A US dollar tranche transaction. Interest rate at that time, fortunately, was also very low then, and we were able to also manage to capture a very good rate. And so I think that's also provided a very good experience for us. The PERP had good response given the market was great. And I think that also gives a very good foundation for also the subsequent successful issuance of the 1.5 billion US dollar bond afterwards. And I think, even on earlier this year, we could see increasingly airports are also tapping into the debt markets in terms of funding, right? I think there are multiple airports in Asia have started inaugural financing. I think earlier we saw Delhi, and then subsequently we have Incheon launching the inaugural green bond. And then I think after that, Changi also launched their initial inaugural bond offering, which were somewhat unprecedented. And but obviously, it's very helpful to give some comparables in terms of airport bond issuance region.
So do you perceive the airport authority is coming back to the market repeatedly? Then is this going to be a funding source that you use in the future?
I think it's part of our plan anyway, irrespectively of the COVID situation. We plan to, opportunistically go to the market at least probably once a year. So it really depends on the traffic recovery. That would allow us to judge in terms of the size of the offering. But I think that we will be at least a regular issuers until the completion of the third runway project.
Okay, excellent. Thanks, Julian. Moving to Bochao. So China is shortly going to open its capital border, the so-called Southbound Bond Connect, to allow Chinese onshore capital to invest offshore in a more unrestricted way versus how it's been done historically. Are you expecting Chinese onshore money to flood into the Asian market? And what do you think the implications of that might be for Asian investors?
Hi, Duncan, and thanks for Standard Chartered for the invitation. Yeah, that's a question actually we've been asked quite often in the last few weeks as the China Southbound Connect is going to happen very soon. And so let me put it this way. So China onshore RMB bond market is more than like USD 15 trillion, while it is like the second largest in the world bond market, just like behind the US. But while you compare to the USD bond market of the China onshore bond market, it's about 600 billion USD. That is already like a 50% of the total Asia credit market. So a lot of investors actually raise a similar concern that are we going to see a flood of Chinese money flood out of the gate when the Southbound Connect happen? And even now, the capital control is more controlled by the so-called QD quota for the onshore investor to come offshore. So on that, so basically, my answer is yes or no. The yes is, of course, we open up a new channel for the capital easier to flow out from the China onshore. We'll definitely see some fresh capital coming out. But also at the same time, we need. I think the money will only coming out when there is an arbitrage opportunity, especially when the valuation for the USD bond is very attractive. Also at the same time, it's also very depend on how the government policy that will also limit how the incremental demand on the money flow. So let me put it in more specifically. So just like in the 2020s during March, so at that time we see the whole capital market was melting down in the USD bond market. So that time the 1 year, like say China property bond was trading below 90K price, and the yield is like 20%. Well, at exactly the same time, then we see the same issuer in China onshore are printing 3-year paper at like mid 4%. So that is clearly an arbitrage opportunity for the China onshore investors. So at that time, we do see a flood of Chinese investors from onshore. They want to come to the USD bond market to invest, to catch the opportunity for arbitrage. But it took most of these people about 3 weeks to 4 weeks time, so actually can cross the border given all the limitations being put on QT quota. So if the Southbound Connect actually makes the cross-border much easier and more available for a lot of people, then what can be expected is if we see a volatility actually is coming from outside of China, say, for example, the pandemic or the Fed tapering, then in that case, we will expect the Chinese money will be much faster to react and will help to smooth the volatility in the USD bond market in that perspective. But if you look another way around, if we are seeing the situation like 2018, that the volatility is actually coming from the credit tightening from China onshore. So in that case, actually, this kind of Southbound Connect flow will create extreme volatility to the downside for the USD bond market, just like what we are seeing right now. So it very depends on how the situation. So I think the biggest implication will be, yes, we will expect money can come out and they will come out. But what for investors is we need to pay more attention to how the China onshore market is happening and how that versus the USD bond market to see the difference over these two, then decide and how should we position for all this.
Okay, excellent. So sort of, I guess, partly related to that, at the moment, the Chinese credit spreads, well, since 2015, 2016, when they were actually tighter than US credit spreads, they've been amongst the widest in the EM markets. I think currently around 300 basis points wider over the US and European credit market. With China being one of the first economies to exit the pandemic and a rebounding economy, do you expect that the spread between China and the US and Europe will converge?
Thank you. I think that's an excellent question. And unfortunately, I think the short answer is, I think it's no. We look at this way. So starting from this year, and if you look at most, say, investment bank and most credit strategies, their pitch on the beginning of the year is like to go long China credit, to go long, like especially on the high yield. So logic is very simple behind. Just like you mentioned, China looks like going to be the first economy to work out from the pandemic in a better situation. Well, at the same time, the yield pickup between the US and China actually looks very decent. However, at this time of the year, if we look back what happened in the last few months is that we will see that actually all the credit event and all the idiosyncratic credit event happen to prove that actually things doesn't work out that way as expected. I think the main reason here is that's why I so-called the valuation trap for most Asia investors when they look at the China credit market, given I think valuation only tells one part of the story of the China credit. So when you look at China, another part of the story is all about regulation and the government policy. So since the second half of last year, China already tightened the credit market, especially to the property sector, and also to allow more volatility in the, say, SOE and also local government entities. So at the same time, then we also need to understand that so China, so every time when the economy was good, China will always use a chance to actually to fine-tune the policy and also to solve some long-lasting issues for the financial system. So in that perspective, then if the economy overall continues to be strong, then we may see actually more credit event and headlines. So that's actually quite counterintuitive for many investors. So last thing I think I want to add is that when you look at the China credit, you need to know one thing that Chinese bank is one of the biggest investors in both onshore and offshore markets. They invest directly in bond. At the same time, they also provide direct lending to corporate, which is one of the most important sources of funding for corporate. At the same time, Chinese banks, they also controls the distribution channel for the retail investors. But also at the same time, the banks are highly regulated and guided by policy. So once any change from the policy maker will transmit it through the banking system, like very quickly, and you will see the behavior change by the banks right away. Therefore, so this will decide how supportive in certain sector of corporate credit. Therefore, I think overall, then if you want to look at China, you can not only look at the valuation, you also look at how the chemistries between regulators and say banks and market participants. So that's my answer. Thank you.
Okay, great. Thanks, Bachao. So if there's increased probability or possibility of defaults on Chinese credits this year, do you think that the Chinese investors will start to look at other parts of the Asian market to invest their money?
Actually, that's a very interesting question. So for us, yes. So for example, actually today, look at the panelists. I think it's very interesting. Since actually we host the one of the first roadshow for many of the investors. For example, we also invest like in Hong Kong Airport. And so the first we see is that the money is coming out. So first they go to invest like Hong Kong and Macau credit. But at the same time, many investors, they are looking to diversify. So for example, like Philippines, India, and Indonesia are the main areas for people to go, and also European 81. But also at the same time, you need to understand how the Chinese investors they invest. Overall, they really dislike volatility, and they always be more risk averse on the names they are not familiar with. So now we do see this start to picking up for diversification, but at the same time, I think it takes time for them to understand. So I really welcome and hope there are more issuers from outside of China can spend more time for Chinese investors to understand that there is a very big world out there, and that is what we are aiming for to push our investors to do.
Okay, excellent. Thanks very much, Bachao. So David, moving lastly to you. Do you think that the deterioration in China and US relations is going to affect your business?
Thank you, Duncan. Well, it's not the first time we talk about the US, the PRC tension. It has been on hot, cold for what, 18 months, 2 years already. I guess the market have accepted that that's going to be like ongoing, and it's not going away for any time to come. But having said that, we still see done get done. I mean, last year, for example, it was a record year in Asia, ex-Japan G3 issue volume, and China is the biggest contributor, around 60%. 60% of the whole region is from Chinese issuers. So you cannot really say that because of the tension that investors are not buying PRC paper. That's definitely not the case. So we see SOEs, FI, LGFVs, POEs, all well received by the market last year. And just one or two examples here. Standard Chartered led China Morph the $6 billion US dollar 1448 trade, and also the 4 billion euro trade. In particular, the 6 billion trade selling to the US 3, 5, 10, 30 years. And in the 10 and 30 years, they were like 40% bought by the US investors. So you're talking about US and Chinese tension, but investors still buying those bonds. So I think that's a good example that I think the investors are aware of the situation, but yet I think when they see value, when they see good credit, I think they still buy. I think the order book for that particular trade was over 30 billion at peak. Even though there were some names on the sanction list, Department of Defense has a long list of Chinese names who are allegedly associated with China military. We see even those names get done. Some of them are associates or affiliates of those names on the sanction list. And earlier this year, we actually saw a name actually on the list, and also got I think the US dollar bond deal done, and the deal was well received by the market. So again, investors are aware of the situation, but they picked the right name as they still see some value in Chinese names. This year, we have seen less issuance from maybe SOEs. So I think the contribution from China year to date, I think slightly maybe around 50%, a lot as high as 60% like last year. And for example, that we don't see a lot of 1448 trade, for example. Typically, every year, April, May, we will see a few SOEs coming to the market. We have not seen that this year. But that doesn't mean that no deals going to the US. Alibaba, Tencent, all tapped the market, did a multi-billion trade, and also well received. The other impact on our business, it could be because of the PRC banks and security house liquidity, and also because of political tension, that there are more and more PRC banks and security house are selected as the lead arrangers in some of these PRC deals. Some of these foreign banks have to fight for the very few spots at the top tier. That's something that we have seen more and more, partly related to the tension. But having said that, the market's still there. There's still a lot of company, SOE, POE, FI that want to tap the market, explore the funding channel, need the dollar funding for the capex. So it's still a big market and enough for everybody.
Okay, great, thanks, David. And going back to the Bond Connect, as Bo Chow was mentioning earlier, are you expecting an explosive supply from China of money? And if so, is that going to affect the way that you pitch deals?
Yeah, I think PRC investors have been buying offshore assets, in particular PRC names, for many years. I think in particular for the past, 3 to 5 years, that we've seen the explosive growth. I like to think that this, with the Bond Connect, Southbound, there will be additional liquidity. But most of the more sophisticated PRC issuers have already found a way to buy something offshore already before Southbound or Bond Connect is established. I'm no doubt that there will be additional liquidity. It might not be as much as what we, I think, initially anticipated. Partly because we're still not sure what product, what currencies will be allowed for these Southbound investors, whether there will be a quota set for this investor to invest offshore, what will be the fund flow control, what will be the regulation on settlement, for example. These are a lot of the issues that I think that everybody's still waiting for the details. But having said that, there are already a few names want to be the first batch of issuer whenever the Southbound Bond Connect is set to launch. Rumor is that the first batch of primary issuance will happen later on next week.
Okay, let's see if if the infrastructure is set up to manage with that.
Yeah, let's hope so.
Okay, so yeah. So last question for you. It's probably with the questions that we get asked the most on the trading desk. Huarong, given the unresolved situation there, do you think that the market has already repriced potential SOE issuance, given the potentially lower government support?
Yes, it's a question that I get asked very frequently ever since this Huarong saga started early April. Yes, I think the market was affected quite badly, I think, in April, when you have 60% owned SOE by MOF and rated at one time A-, and the cash price of the bonds dropped from over 100 to, I think some of them are 50 to 60, is a big issue. And there were so many bonds out there. I think at the peak, I think there were like $22 billion issue in the past, like, I don't know, 7-8 years. So a lot of different type of investors are affected, and I have to say, lose money. So I think all this uncertainty of Huarong and what's going to be happening to Huarong is not helping the market. And for a few weeks in April, we have seen the significant reduction of the issues because of that, and investors simply not too keen to buy any PRC names. And for that matter, and some other countries benefited. I think in April, I think some of the issuance in Korea, in India, in Singapore, I think they all traded well and priced well because I think we have seen some international investor moving to other countries and stay away from the SOEs. So on this repricing, I don't think it's happening yet, but definitely international investor have taken a closer look and more selective and want to pick the right names. So we'll look at the rating, we'll look at the issue structure, look at the industry, not just look at the, because it's an SOE that they buy. And they're definitely more cautious. And for those names, weaker names, they definitely have to pay a premium. So I think that is definitely happening to international investors. Might not be to the PRC investors. I think the PRC investors know what they're buying, and they're familiar with the issues and the landscape, and they understand the names better. And so I think they're still buying most of the names. But for the international investor, where some of them got burnt by Huarong, definitely pick the white ones. But having said that, I mean, we still have seen a lot of deals for good names at the right price, and they're still getting the support from investors. So I won't say a over the board repricing, but there's a selected repricing to certain names.
And so following on from that, do you think that the rating agencies are likely to be a lot harsher going forward?
Well, yeah, I think we definitely have seen a lot of activities from agencies on some of the names. I think the market will feel that they were rated maybe a bit too high. I think there are now a bit of adjustment happening to some of the weaker SOEs across the board. And I think in the past months or so that definitely some downgrades happened.
Right. Okay, brilliant. Thanks very much for that, David. So thanks very much to everyone. Thank you, Umesh, Kenneth, Julian, and Bo Chow. And I hope that everybody in the audience has learned as much from this session as I have. Thank you very much and goodbye.